Welcome to Crypto Clarified, Investing in the Truth, a podcast series where we come together to discuss the most captivating headlines and trends in the digital asset space. My name's Benjamin Dean. I'm director at WisdomTree's digital assets team. I'm joined today by the ever-brilliant Cami Russo, founder of the Defiant Media, Defiant.io. Cami, Merge Week. How are you doing? How are you surviving?
It's exciting. It's pretty wild that it's finally happening after years and years of anticipation. It's a huge week, I think, for Ethereum, obviously, for crypto in general. So really excited to see what happens.
Well, go to the Defiant.io if you want news on the merge. You can also go to the Defiant.io if you're just feeling a bit defiant for whatever reason.
Exactly.
I don't know whether it'll make you more or less defiant. But if you want to let us know, you can let Cami know at Cami Russo on Twitter. You can let me know at Benjamin Dean. And well, look, before we begin this session, we're going to cover ESG and how it relates to the merge. It's one of these narratives that's emerged, no pun intended, as the mergers continue to be going on and on and on in mainstream news. But before I begin, I need to do the following. Shout out to Sam and James in compliance. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and Defiant Media and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. Information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and the reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. One day I'm going to try and do that without taking a breath and see what happens. But if the worst happens, Cami, you'll be able to cover for the rest of the show. It's like they resuscitate me.
Okay.
It's the end of the housekeeping. So now we go on to the fun stuff. ESG and how it relates to crypto. I'm going to kick off by explaining what ESG is and why institutional investors are interested in it. Then Cami and I are going to unpack the three letters and how it relates to different parts of the digital asset and crypto space. It's a topic that's actually quite nuanced. And well, we hope that listeners find it useful for us to go on a deep dive. ESG is a concept that, so while I like to say I'm a cybersecurity person, I also have a degree in economics. And when I was younger, not that old yet, I don't think, but when I was younger, I did a course on business ethics. This was about 15 years ago. And the whole course was built around an idea that was new at the time. It was nascent. The idea was that companies should have a responsibility beyond that of just giving returns to shareholders. That's something Milton Friedman posited in, I think, the 80s. And this new school of thought said that no, companies also have environmental, social, and governance responsibilities. And so they need to change their corporate practices in order to provide these responsibilities to stakeholders beyond just their shareholders, but also broader society. So in the time that's passed, well, a lot's changed in the world, hasn't it? And this ESG movement is now like a full-blown industry in of itself. Lots of large asset managers and investment banks have what they call ESG screens, where they in the past have filtered out certain kinds of companies, like fossil fuel companies and weapons manufacturers. The concepts are a bit slippery though. And I guess one way for us to enter this discussion is the way in which it's been introduced this week. The idea that Ethereum is moving to a proof of stake consensus mechanism. Cami, give a quick, and I know we've done this a few times, but what are some of the implications, maybe the biggest one, the next biggest one of this move to proof of stake at a technical level?
Yeah, so what the merge does is it replaces Ethereum's proof of work chain with a proof of stake chain. So the entire application layer of Ethereum, so all of the the projects, applications, tokens built and issued on Ethereum stay the same, but the base layer, the consensus layer that is approving all of these transactions is replaced by a new consensus mechanism called proof of stake. In proof of work, this is the same consensus mechanism that Bitcoin uses, The way that node operators or miners secure the network is by using energy to get mining rewards. So the more energy you consume to solving these kind of encryption problems, the more Bitcoin or the more Ethereum you get. So miners are incentivized to spend huge amounts of energy and electricity to be a part of the network, because that way they get more mining rewards, more crypto, essentially. In proof of stake, the way to secure the network is, instead of by measuring by the amount of energy you use, validators get rewards by the amount of stake or capital they put to the network. So that means that suddenly the Ethereum network will require a lot less energy to be secured, because node operators are no longer having to spend these vast amounts of energy to get their rewards. Now all they need to do is just put Ether deposits into the network. So that will reduce energy, the amount of energy spent by 99%, I think is the number. It's just like, basically just completely reduces the most of the energy that was spent in securing Ethereum.
Great, exactly. So you've got Bitcoin and, until recently, Ethereum using proof of work. Proof of work needs large amounts of electricity. Headlines screaming for years that Bitcoin's going to boil the ocean. It's going to use more power than the world combined, more than Finland. So there's been a narrative that's been going on a while. It's premised on the idea that the energy use isn't worth the utility that people derive from the network. And especially in context of carbon outputs, they say, well, it's not ESG friendly. And remember, carbon outputs are just a small part of E. And we could argue about whether the utility derived from the Bitcoin network offsets the energy use. It's kind of 0.5% of the world's energy use, half of which is renewable. So we can go all the way down that rabbit hole, Cami, but I'm not actually sitting down today and going over those lines over and over and over again. I don't think it's terribly constructive, because there's 3 letters in ESG: environmental, social, and governance. Now, in your experience and given your background, I think you've got some interesting things to say about the S and G implications. We could treat Bitcoin, a globally accessible form of non-debasable digital cash, but we could also talk a little bit about Ethereum and the different ways in which it can be used to improve social or governance outcomes. Let's impact maybe the social element. Do you have any experiences that show where uncensorable digital cash might have some social benefits?
Yeah, I think this is such an interesting take on ESG, because you're right that a lot of most of the focus is placed on the on the environmental side of things, but decentralized public blockchains have huge social and governance implications. Even if the E isn't taken care of, I think the fact that there's now a system, a currency that can be accessed by anyone, and that allows people anywhere in the world to transact freely, has huge social implications. I mentioned before, I worked for years in Argentina. I'm originally from Chile, so I know kind of the South America issues very closely, and it's a place where there is a lot of economic mismanagement, unfortunately, where governments just print their way out of their problems, so that causes a lot of inflation. Then inflation means that the local currency is being devalued. That prompts governments to place currency controls, which means effectively limiting what people can do with their own money, and not being able to exchange local currency for hard currency, for dollars, or a less volatile currency, to not being able to send money abroad to maybe a safer jurisdiction, and so on. It's a huge issue for large amounts of the world's population. Obviously, not only in South America. This is an issue for many emerging nations that are dealing with economic mismanagement by their central banks and their governments. So yeah, like having an alternative to that, a network that anyone can access, that you don't have a central bank controlling it, you don't have a government controlling it, that can provide a way of protecting people's savings from devaluing currencies, is huge. I mean, that's what makes me so passionate about the space. I really do think it's a system that's, because it's so open and permissionless, it really has the potential of directly kind of changing people's lives. So that's where the kind of S and G component of ESG comes from. Like, even if you're spending a lot of energy to secure these networks, I think just by these features and characteristics, to me, like, my personal opinion is you're making up for that. Like, that energy and electricity, especially because a lot of it does come from renewable sources, is really well spent. And now you have the added benefit on Ethereum, at least, that you're not even spending energy to secure it. So it's pretty good.
Yeah, we talked about the truckers. Remember the month when the Canadian truckers happened, and we talked about uncensorable digital money. Yeah, you and I have talked about.
So not just in developing nations,
Yeah,
can also happen in Canada. Yeah,
exactly. So it's one of these things where these kinds of problems rear their head all around the world. And the other thing is that people used to say to me, like, Bitcoin, nobody uses it. And this was because it was like the first years of Bitcoin. You can, of course, build on top of Bitcoin, layer 2, like Taro, which will allow kind of stable coins to run using the Bitcoin network security. So over time, the networks can evolve. Of course, the Ethereum network comes along, and you know how big stable coins are. You probably know lots of people that use US dollar stable coin, send money in and out of Latin America. I certainly know people who do it, send money in and out of Turkey and China. And then there's another element, which is like, well, if the software evolves over time and more people use it, and the software becomes more scalable in terms of its transaction throughput, then you almost have to take that, even if you assume carbon output is the relevant metric, you have to then change the denominator at the bottom. So for every unit of carbon output, you're getting more and more and more and more, but you don't get there unless you start at square one. So the idea that you just kind of don't pursue something and then forfeit all future benefits seems a little bit short-sighted in my mind. But hey, that's what goes on all the time. There's a couple more elements. We've got a relatively short episode today, so I'll have to kind of be succinct here. There's one element with the Ethereum's move to proof of stake, so it does reduce the energy use because there's no mining, but you still need to get computers, right? People need to run computers. That means you have to mine materials and build superconductors and then put them together. It's still how it works at a technical level, right? It's just instead of miners, you have validators.
Yeah, that's right. I mean, to run a node, a node is basically, a machine that's running the Ethereum, like an Ethereum client, an Ethereum, like, code base. So you do need that piece of hardware. The argument there is that it's not like a really sophisticated piece of hardware. Like, it's not very expensive. to acquire an Ethereum node and to set it up. You know, it doesn't kind of compare to just the amount of infrastructure needed for running a proof of work mining rig with all its, you know, like even just like the space, like the fans that like you need to cool them, and there's like a lot more just like hard materials involved in that process.
I suspect part of the reason we don't see that narrative emerge very much is because if a journalist wrote that, they'd essentially have to like forsake their cell phone.
Right.
And we know everyone's addicted to their cell phones, so I don't think they're going to immediately throw them out. Not
right.
to mention
I don't think kind of the hardware required for running an Ethereum node is much different from, you know, just like your everyday laptop. So,
you know, the other people who would benefit this, and here I'm trying to be funny, gamers.
Oh, right.
Because the gamers have been paying more for their graphics cards for years, and now like all those graphic cards will hit the, so they'll pay less to game, and that's
interesting. I wonder if the price has already been impacted. Maybe that's already been priced in, graphics card, you know, prices going down. But yeah, gamers should be happy. Maybe that compensates for kind of all the anger they have with the NFTs. I don't like, there's this whole kind of gamer versus NFT crowd going on. So I still think gamers or a lot of them are really, you know, are still going to be anti-crypto, but at least that's one less, you know, thing to worry about.
Yeah, one less group of people to cause trouble and disrupt you as you're trying to like patiently explain things like the merge. It's not a topic we have enough time to go on detail today, but I like that you just said maybe it's already priced in. You've been watching, no doubt, the Ethereum price the last few months. I sat down in a meeting 4 months ago, maybe, with an institutional investor, and I said, you know, the merge is coming of Ethereum. This person said, well, if the merge is coming, isn't that priced in already? Like, I'm not sure that like that's fully, the full implications of this change are really fully thought through.
I don't think so. I mean, I think, you know, I don't think we'll see, and I hate speculating on price. Like that's not my place or my thing, but, you know, just take everything I say with a grain of salt in terms of price. But I don't expect there will be a huge kind of jump on the ETH price, like, you know, after the merge. I think that's, you know, well known that it's happening. I do believe that kind of the event itself it's pretty well priced in. And by the event itself, I mean, you know, the merge actually being, you know, executed correctly. What I don't think has been priced in very well, because I think just very few people understand the impact, is the changes in Ethereum inflation rates and issuance levels. So the merge will have an impact, or I should say proof of stake will have an impact on the amount of Ethereum that's in circulation. So the inflation rate of Ethereum will come down, and more ETH will be burned per transactions if all things remain equal. You know, if you have the same level of activity, more ETH should get burned, which means there should be less ETH in circulation. So that's what I think could have a longer term impact on Ethereum price that we just, you know, can't see at the moment. Like I think it's really hard to predict what that's going to do with ETH price. So that's something to watch.
We'll see how it plays out. Lots of uncertainties. We've talked assuming that it's going to go smoothly. I guess it'll be interesting when we speak next to kind of see what the short-term consequences are. The nice thing about today's session is we've done the myth-busting session throughout this talk. I was originally going to point to an article in The Economist which is the most popular article on The Economist last week on Ethereum's move to proof of stake. But since then, I've seen articles turn up in the New York Times, Financial Times, and Bloomberg today alone. And every single one of them mentioned this idea that it's more ESG friendly. And I think today we've managed to provide enough nuance around that claim that the listeners can walk away feeling like maybe the myth's not totally busted, but they at least know like where myths lie and where they maybe don't lie. Look, Cami, any final words before the merge happens? And no doubt, like you're going to have a very, very busy week.
Yeah. I guess like excited to chat after the merge happened and see what kind of the initial consequences and effects have been. And yeah, again, kind of prompting everyone to go check out the Defiant coverage on it. We're all over the merge, so subscribe to our newsletter, to our YouTube channel, check out our website on the defiant.io. If you're in New York, you should stop by our post-merge party on Thursday at the Defiant headquarters in Brooklyn. So we'll be kind of announcing the details on our Twitter. So head there if you want to stop by and say hi.
Is it fancy dress? Like are people coming dressed
no.
as unicorns or something?
Oh, maybe you'll see some of that, but not fancy.
I have no doubt from the Ethereum crowd, there'll be plenty of people in like furry onesies and unicorn hats and whatnot.
We can only hope.
Sounds like a cool party. Unfortunately, I can't swim across the Atlantic to be there, but everyone have fun. We're out of time though, unfortunately. I hope everyone found today's podcast useful and informative. As a reminder, if you'd like us to cover any specific topics in future episodes, please email cryptoclarified@wisdomtree.com. Go to the defiant.io for all your DeFi needs. You can follow Cami at Cami Russo on Twitter. You can find me at Benjamin Dean. Thanks for listening. I hope you have a great day and ciao.
Thank you.